Ireland's parliament taking up a tough budget vote. Our next guest says the fate of the Eurozone is unclear. Charles Dumas of Lombard Street Research is with us now. He has 40 years of experience as an economist and an analyst. His third book, Globalization Fractures, was published this fall. Charles, thanks so much for joining us. There's a lot going on in the Eurozone right now. In general, you say a breakup is more likely than a German-funded superstate. Why is that?
Well, because I think the German-funded superstate has a lot of disadvantages for the Germans. First of all, they have to pay good money to support these club-med countries more or less indefinitely. And they've already been doing that until recently for East Germany, and I think they're probably fed up with that. But secondly, in the sort of euro structure as it is now, Germany is undervalued, and the result is that they are already, as a result of quite a good recovery to date, at their sort of trend level of output. If they grow at all fast now in order to compensate for weak growth elsewhere, then Germany itself is going to have inflation, and they won't like that.
So it was no surprise to you at all that we heard Germany blocking two key proposals, if you like, from the rest of the Eurozone, this idea of the enlargement of the Plan B fund, about $600 billion, or the idea that this pan-European debt agency could be created. Those were two ideas that came up in Brussels yesterday. Germany said no to both. That was not a surprise to you, right?
Yeah, I mean, I think the Germans are quite right, really. I mean, if they accepted this arrangement, then essentially the German credit would start to be subsumed into the European superstate credit, if you like, or what is a sort of starting point for going down that road. And the result would be that the German government's borrowing costs would go up quite a lot. It's not just a question, you see, of the rest of Europe converging on Germany and having low inflation. It is also a point that the Germans have to risk their inflation picking up and their interest rates picking up if they wish to converge with the rest of Europe. And I don't think they either would like that or should like that.
Charles, it's hard to look at today's news without looking at Ireland and its budget. I mean, you've said in the past that Ireland was actually the best positioned in the Eurozone to weather the crisis, but they have failed dismally. This budget is basically going to make more people pay more in taxes. How long before mass social unrest takes hold of Ireland and perhaps the rest of the Eurozone?
Well, you know, your guess is as good as mine. If I was involved, I think I'd have been on the street already, to be quite honest.
Yeah, some people are going to see increases of 20%.
Yeah, the Irish situation is pretty drastic. They already have, as a matter of fact, now competitive wages. They've lowered their wages below those of Germany relative in unit labour cost terms. But unfortunately, they're now hammering their economy with a total deflation of 9% of GDP, which means domestic demand will be down heavily. And so they may well have a little bit of export growth, but the overall output of the economy is likely to decline, contrary to their forecasts. And that means that tax revenue will be disappointing, and that means that they won't get the deficit improvement they're hoping for, because they're hammering the economy. And that in turn means that GDP is going down, nominal incomes are going down, so the ratio of debt to income is going up pretty fast.
Charles, thank you so much for your time. Charles Dumas joining us there. He is from Lombard Street Research. You heard him say all pain and no gain for Ireland.